Welcome everyone to Patrick Boyle on Finance. Today we have Jack Schwager on the show. Jack has been involved in financial markets for over 45 years. He's worked as a market analyst, a trader. He's managed institutional portfolios of managed accounts and has written extensively on the futures industry and on great traders in all financial markets. He's been interviewing the greatest traders in the world since the first Market Wizards book in 1989 and has just released the newest installment of that series, Unknown Market Wizards. Welcome to the show, Jack.
Thank you, Patrick.
It's great to see you. So I guess in order to kind of get going, I thought before we dig too deep into the stories of the great traders that you've uncovered in this most recent book, I figured we'll gap back to the book you wrote just before, Market Sense and Nonsense, which is one of my favorites.
Thank you.
And I guess we should talk a little bit about the efficient market hypothesis and how well you think that holds up.
Yeah, so there's no doubt in my mind that the efficient market hypothesis is wrong. And I have a whole chapter in the book you mentioned with, God knows, probably a dozen reasons, or proofs or explanations of why that's the case. It's wrong on so many different levels. Well, first, basically, the basic premise of the efficient market hypothesis is that the market, all information is known instantaneously, and the market responds instantaneously to all known information. So there's no way you can get an edge in the market. It's you're just kidding yourself, and anybody who comes out ahead is just basically lucky. It's just like, at a roulette table, most of the people will lose. I guess in the markets, maybe the majority of traders will lose because they're all on the wrong side of the bid-ask spread. And although it's different for the markets because, the contention of the efficient market hypothesis is that you can't get an edge, but of course in the markets you can. In any case, that's the concept, that everything is known, you can't beat the market. Now, there's so many examples of where you had situations where you can't possibly explain that the markets are efficient. I mean, it's just, and well, take one of the big ones, NASDAQ yeah. In the late 1990s. So we have in not 3 years, and it's about 18 months, a year and a half, the index of I think it's the NASDAQ, the internet stock sector.
Yeah,
that sector goes up 600% in a year and a half. Mm-hmm. Wow, there must have been some tremendous information coming in, right? And then in the next year and a half after it reaches that high, it goes all the way back down. It's like an 85% loss, which, 600% gain, 85% loss works out about this, come back to the same level. So you have this, incredible, astounding bull market, an astounding crash. And you must think, wow, what was all this bullish information that came in? And what was all the bearish information that came in, on the decline? And I challenge anybody to really go through and explain that what really changed from that big bull market to the big bear market. Well, nothing. There was a premise that the internet was going to be big. That's fair. But then you had a whole bunch of companies which had no economic reason to exist. Companies that, like Pets.com, the famous one, which the more they sold, the more they lost because their shipping costs were higher than their, what they were getting on a profit. And I jokingly say sometimes when I talk about this, that they went out of business in 10 months. And they would have, I joke, they would have lasted longer if they didn't sell so much. The more they sold, the quicker they went out, the quicker they burned through their capital. In any case, you had all these companies that had no reason to exist. And they, a lot of them went by the wayside, but didn't stop them from going from 10 to 200. Now, was there really bullish news? No. These companies were never economically viable.
Yeah.
But you had everybody afraid of missing, my neighbor just made it, doubled his money. Everybody's just piling into these same stocks. So it's purely an emotional thing. You can't explain it by the market, reacting to news. So that's a good example. One other example I'll throw out, I got to see Richard Taylor, who's one of the pioneers of behavioral economics.
Yeah.
And I think behavioral economics is really, they've got it right from the very beginning. about the efficient market hypothesis. Anyway, I saw him when I was living in Seattle, and he gave this presentation. And he had an example. I have a bunch of examples when I give a talk on that, on the same topic, but he had one that I didn't know about, and I just loved it. So it's a closed-end fund call with the ticker symbol CUBA, Cuba.
Okay.
And it invests basically in South and Central America, or whatever. That's the fund. And as you know, or you might know, or your listeners might know, closed-end funds tend to trade at a discount. We don't have to go on a tangent, but they're a fixed portfolio, and they tend to trade at a discount. And like most closed-end funds, Cuba's trading at a 15% discount, which is not unusual.
Yeah.
And discount, I mean, if you liquidated the entire portfolio, it would be worth 15% more than the fund's trading. Okay, so one day it goes from a 15% discount to a 70% premium. I mean, so what happened? Well, what happened is President Obama announced we were going to normalize relationships with Cuba. Now, here's the kicker. Cuba doesn't have any stocks. So it just had the symbol of the index of that closed-end fund was CUBA, but they had no holding because there were no stocks in Cuba. And even if there were stocks, it would have been illegal to invest in stocks in Cuba if they even existed. So you had this move, like an 85% move in one day because of the name. Now you go and tell me the markets are efficient and discount, the price is right. The price is not always right.
Yeah.
Now, the thing is, the markets, and I can go on and on and on this, but let's cut it to this point. The thing about the efficient market hypothesis is that, in many situations, the markets do act like they're random. Yeah. And because the markets are very difficult to beat, and because these emotional mispricings that occur are difficult to exploit, because, like the NASDAQ, well, it shouldn't have gone up. It could have gone up a bit, but not 100 or 200 or 300. But you don't know what the top is at 300%, at 400%, 5%. So you could go broke multiple times before the market actually tops. So even though one can identify this is definitely a bubble, without doubt, it's still very hard to take advantage. Yeah. So it's, for the most part, the markets do act like they're efficient, even though they're not.
Well, a good example actually is even, and I think it's from your book, is the example of Palm Pilot in the late 90s as well. And it was spun off from 3Com, but the prices just didn't reflect each other. These two ways of investing in Palm Pilot. You could buy either company, but one had the ticker PALM. And for people who are younger watching this, Palm Pilot, it's kind of like a BlackBerry, which is kind of like an iPhone.
It was the iPhone of its day.
It was a terrible thing as well.
There was a lot of hype, and when 3Com was spinning out Palm as a separate subsidiary. But if you own 3Com, you had X number of shares.
Yeah.
So 3Com was like Palm plus the rest of the company. And when Palm came out that day, there was such a demand for the Palm that when you worked out the value of the Palm stock in 3Com, the rest of the company was trading at a large negative number.
Yeah.
The market capitalization of the rest of the company was largely negative, which is impossible to persist.
Yeah, because they had profitable businesses in there. But the funny thing about that even is that wasn't even a big secret. Like you could imagine even, we'll say with the closed-end mutual funds, that it's sort of a thing that only a few people are watching. But this was there were cover stories on the Wall Street Journal about this inefficiency in Palm, and it continued on for months.
Absolutely. And what I love is people say, well, the reason they couldn't correct this because normally arbitrage would take that right back.
Yeah.
The arbitrageurs couldn't do it because they couldn't get the borrow to go short the Palm. And that may be true. But what about those stupid investors who are buying Palm when they could have more Palm stocks for the same money?
Yeah.
Plus the rest of the company.
Yeah.
Yeah, so it doesn't explain the paradox. You can only.
So I guess my follow-up question then to the efficient markets hypothesis is then, if there are flaws in, I think the efficient markets hypothesis is sort of useful for a lot of people, in that for many people, I often say, if you're a doctor, you'd be better off earning a living as a doctor and then investing in an index fund than trying to beat the market. But what are your thoughts on the idea, like, if there are these inefficiencies out there, can anyone take advantage of them? Or, what's interesting about your book is, I guess many of the people who have done so well in the markets, they're very interesting people, but they're kind of rare people. There's not a ton of them out there.
Yeah. So first of all, since you read the book, at the end of the book, probably the last point I make is that even though I've written about these people who have done enormously well, and I believe that the efficient market hypothesis is wrong, ironically, most people would be better off behaving as if it were right, which means for most people, the right advice is buy a low-cost index fund and hold it for 30 years. That's the exact opposite of trading, and the exact opposite of believing the efficient market hypothesis is incorrect. But the distinction is, I think, the world can be divided into two. The world of traders / investors can be divided into two categories. Those for whom trading or investing is a passion, and they've developed a methodology that has some edge. They've learned proper risk control, and they both enjoy the process, and they have some skill at it. So their trading is at least net profitable, right? So that's one group. I mean, not necessarily market wizard profitable, but they at least, and I put myself in that category. I'm a profitable trader, but I'm not a particularly good trader. So, and the rest of the world who really don't want, if they're going to do what they want to, their ideal would be maybe, if I could spend an hour a week and make 100% a year, that would be okay. And that's why they buy all this stuff, which is worthless. But for that world, which trading, investing is not a passion. They're not willing to devote, or don't have the time to devote time to learn the skill, to develop a methodology. They're better off just, acting as if the markets were efficient. So I think it depends what category. Now, can anybody, turn into a market wizard? No, of course not. No more than every running afficionado is going to run a marathon time, no matter how devoted they are. You'll only have a tiny percentage in any endeavor, whether it's music or sports or trading, any field. There's only going to be a small percentage that are truly outstanding, but that doesn't mean that there's plenty of musicians around the world that are perfectly good, excellent, but they're not soloist level in front of a major philharmonic orchestra. Doesn't mean that they're not talented. So there's also community orchestras have musicians who are perfectly fine. It doesn't mean that they're anything wrong. They're successful, but they're not like out of this world, skill, right? So in any profession, that's true, and trading is no different. But can people become net profitable? I think most people, if they, just like running a marathon, you can't get closer. You couldn't run a mile if you're out of shape. You can't run a mile. But if you're devoted, and even if you're out of shape, if you're really rigorous about it, you can eventually run a marathon. Almost anybody can. It's very difficult. It takes a lot of work, but it can be done. But they're not going to run a marathon, a world-class time. So same with trading. Devote enough time, have the passion, do the work, develop the approach, develop enough of a capability type of, in the endeavor, which in this case is trading. And then you can, I think most people could at least get to the point where they are net profitable. I don't know what percentage that is, but let's say a meaningful percentage. I don't know if it's more than 50% or less, but a meaningful percentage of people with the proper work and devotion can reach some level of capability.
Now, there was a lot of, in this book in particular, I guess in all of the books, but I felt there was quite a lot in this book about the sort of emotional difficulty of being a trader. You know, there was one line I really liked, and it was someone described it as being a hard way to make an easy living.
Yeah.
And do you think, like, I almost think like when we talk back to Taylor and behavioral finance, do you think that it would seem to me that one of the difficulties in doing well in the market is often it involves stepping away from the crowd, like it involves not having a consensus opinion. And is there just a certain mindset of people who are able to really just hold their own way, or how do you think that works? Is that what trips up the average person?
Well, I think the ability to go against a crowd is a certain type of trading. And in fact, like in one chapter in this book, which focuses on a purely contrarian trader, that is his approach. I mean, literally, he's always the old advice of don't try to pick tops and bottoms. Well, that's literally that is how he earns his living. He picks tops and bottoms. But that's a specific type of trading style. It's not right for a lot of people. It may be perfect. Like he has this net personality, which he likes to be on the other. That's him, that's his. So he found an approach that really works with his personality. Now, you have to marry that with risk management. Otherwise, that type of approach will kill you. But he has done that, and that's why he's successful. As far as the difficulty or the emotion, it's not, I have a line in one of my books, like there are a million ways to make money in the markets, but they're all difficult to find. And so it is difficult to find an approach that really does have an edge and that works for the person. It can take, and a number of traders talk about it taking, people should think of at least 3 to 5 years before they reach that point. It could be 10 years, it can take a long time. And so there is that element of hard work involved. And I have found that traders, almost all traders that I interview, tend to be by nature hard workers. They're really, you just repeatedly throughout this book, you could see these people devoting, like one Amrit Sal talking about how when he first got into trading, he would literally spend 18 hours a day, just trying to absorb everything and learn. And to this day, and you talk about the emotion of keeping emotions under control and focus. He literally, he will plan. He has these big trades he plans for, usually centered around events, and he will before he does all the research and preparation and writes out a whole strategy of what he's going to do, and he goes back to old trades in similar markets, and he's very prepared. But the day before the trade itself, before the event itself, he'll do meditation, he'll do breath work, he'll get in what he calls it, I think, a deep now state. And he gets just totally focused. There's nothing, his fingers on the mouse, he knows exactly what he's doing. He's waiting for the news announcement, and his world is confined to that screen. That's 100% of his focus. I think the room could catch fire and he wouldn't know. He's that focused. And that's total control of your emotions, basically. You've planned everything out. You know what you're going to do. You've relaxed your mind and body. You're very focused. And if you're going to be wrong, your reaction is ready to be planned. And he's the type of trader that if the market doesn't behave as he expects, he'll be out in less than a minute. So,
Well, one of the things I thought that was interesting in this book, and in particular, it seemed to be a big idea amongst the group that you met in London. There were about 3 different traders that were all sort of part of a group. And there was almost a feeling in there of the idea of trading as a form of self-improvement. And this is slightly something I've felt for years working as a trader, is that when you're doing this job, when you're buying and selling and you're being right and wrong, and I guess the big difference between trading and investing is just the holding period. And at least for me, I'm quite a short-term trader. And I really know how much I'm right and how much I'm wrong. And maybe that's a difficult thing for people to get into their heads, because I think people want to think that they're always right. And to a certain extent, there was a lot of this idea of kind of, that you had to, that trading exposes your flaws. And I thought that was a very interesting idea, because I think it's very true.
Yeah, and you mentioned like one of these. I think it's true of all three of those traders, because they knew each other and were in the same environment and developed some of the same attitudes and approaches. And I think Ahmed, who was the oldest of the first of the group that was a trader, he came. Dalgett came a few years later, and Richard a couple of years after that. But this idea of keeping these daily records of everything that you've done, and like somebody like Richard Barge, who's the last of the three.
Yeah.
I mean, he has a spreadsheet, and on the spreadsheet, he'll have a bunch of different columns which have to do with different types of emotions. And if he displayed that type of emotion or did that type of emotional type of trade, he'll check that box. For example, he has like 20 different things, but like one of them he calls sugar trades. I said, what is a sugar trade? Well, a sugar trade is any trade that's not pre-planned, and that's really not part of your methodology. You just want to take the trade, just like entertainment or for excitement or whatever. And, of course, you don't want to take sugar trades, but if he occasionally lapses and does it, he'll check that box. So at the end of the week, he'll see what boxes are checked. It's basically an emotional scorecard, and those are the areas he has to work towards self-improvement. And Richard also interesting in the book, and for any of the listeners who might have dealt with depression, I mean, he had really serious problems with depression, and the same types of skills he had to develop for, the fact getting into trading probably led to his, curing himself of depression, in that he realized that he couldn't be successful as a trader if he still had to be dealing with depression. So that sort of motivated him to deal with that problem as well. But a lot of the same emotional things overlap in both areas. And, so absolutely, your assumption or your premise is correct.
Now, another interesting thing in there is there's often this story with great traders. There's sort of the story of their early failures, and then they learn and come back. And I guess I wanted to ask your thoughts on this idea. Like, is failure itself necessary, or is that just a symptom of someone who really tries? And is it just a mindset of not giving up that helps, or what is it, do you think, that sort of ties in? Because some of your traders, they had no history of failure. It just worked from the get-go. And I thought there was one idea that was interesting in there, where someone put forth that failure is just feedback, right? Because you do a trade and it either works or it doesn't work. When it doesn't work, that's feedback. And you need that feedback in order to learn and to work out what you're doing wrong. And that reminded me a little bit of, I can't think of the name of the book, but by Annie Duke, the poker player, where she talked about how the great players really analyze the bad players just go, oh, well, that was a bad beat. I should have won, but I didn't. While the great players sit down and say, what could I have done differently? Like, where's the mistake? What are your thoughts on that?
So you raised two important areas. First, the failure at the beginning of in the early years of a trading career. And second, about feedback. So let me talk about them separately. So one surprising thing I had from the very first Market Wizards book was how many of these traders had early trading year experiences of wiping out, sometimes multiple times. And that's still true in this book as well, as you note. So there are two lessons to draw from that. One is that early failure is not necessarily predictive of future failure. You can fail miserably in the beginning and still be enormously successful. And a second is that these people who became market wizards obviously had great resilience, great conviction and belief, and just stay with itness. Because the the classic would be Michael Marcus in the first Market Wizards book, and I won't go through it, but there are so many repeated failures, and you become exasperated just listening. And at one point, I think I say, "Did you ever maybe think that you weren't cut out to be a trader?" And he just said, "No." He kind of just he had this inner voice that just said to you, "You know, you could do this. You could." And I mean, he went on to take a $30,000 account into $80 million. But he had, most people would have quit many times before he got to that point. But he had this inner belief, this inner drive. So yeah, that is an important element. Now, early failure certainly doesn't mean you're going to eventually succeed.
Yeah.
But the important point is it doesn't mean that you can't succeed. It just means you have to use. Now we go to the feedback. You have to use those early failures as instruction. And this important lesson is you have to learn from failures. This is like, I don't know how many times traders have brought this up repeatedly, time after time. The classic example is Ray Dalio of Bridgewater, who basically built the world's largest hedge fund on a philosophy that failure is the most important thing. Because from failure, you can learn how to improve what you're doing. And that's his basic philosophy. And, like I say, he built the world's largest hedge fund on that basic premise. In this book is a good example of learning from failure. So the contrarian, Jason Shapiro, first decade of trading, he, managed to run up accounts like from whatever, 100,000 to somewhere close to 1 million. And each time he totally wiped out the account. And the second time on, while he was making money, he bought a Porsche, which is fortunate because when he wiped out the account the second time, at least he had the car. He had something left over. But 2 times he completely blew out. And he went on to be quite successful. But what the change was that he recognized what he was doing wrong. He recognized that he was fighting. Yes, his nature is to fight markets, but he finally understood that he can't fight markets without having a risk management strategy. He has to know, he can't just say, I think this market is overbought, I'm going to go short here. He had to develop a methodology that identified particular points where that made sense and that allowed him to place a stop within reason that he could take that trade and not lose too much if he's wrong. Yeah. And one of the things he says in that chapter is, I will never, ever, ever not let my stop operate. So that's a religion now. And he talks about how he sees people and he sees himself and how they were wrong, how they're making the same mistakes he made. And he can use them almost as contrary indicators. And he emphasizes, not because he says he's smarter than they are, because he recognizes himself at an earlier time in them. And therefore, and he knows how wrong he knows how that ends. He knows that ends up they'll eventually get wiped out. And he can almost use them as contrary indicators.
Yeah. Now that almost leads to another thing that I thought was quite interesting in there, was that there was a lot of the different traders from different backgrounds and different approaches all talked about how markets have changed. It started out with Peter Brandt, who's been at it probably the longest. Near the end, you got to a systematic trader, which is someone that I can relate a little more to. But in his story, he very much, because he kept all of his old programs, he was able to say which ones worked, which one didn't, when they stopped, and so on. And I've always believed, kind of from my background of working with Vic Niederhofer and just from doing this for 20 years, I've always believed that markets are continually changing and that you have to expect change. Now, I think with a systematic trader, they see the change very starkly because you just see a system that did work that no longer works. But to a certain extent, I kind of got the feeling that with the discretionary traders, maybe they, didn't sort of outwardly have a statement that a given system was no longer working, but that they just sort of adjusted based, once again, on this market feedback to because Brandt really described that he had moved, his initial classical technical approach was very different to what he does today.
Yeah, so I think for both discretionary and systematic traders, this adaptability is important, is critical. And like a trader like Amrit and Dalgett and Richard, all three of them to some extent. But one of the things is initially they would like have an opinion on which way an event would go, or it would be a surprise. They would go immediately. They would go immediately with any surprise, and that might have worked originally. But then you got programming progressing so far that you now had algorithms that would look for words, and those algorithms could respond much more quick. Impossible for human to compete. So I think Dalgett, I forget which one it was, but mentioned that Trent changed his approach from that to actually letting the first reaction go, and then actually waiting for that to go too far, and then trading, almost the opposite, almost a reversal of the original strategy. The systematic and Brandt, as you mentioned, going from a classical chart analyst, seeing chart patterns no longer work and adapting to that and changing, still using charts, but using them differently. And then you have the systematic trader, Marston Parker that you mentioned. That was fascinating because, so he got into trading by being a software guy. He wasn't a trader. It's being a software developer that he got into it. And so having been a software developer, God knows how many systems he's developed, but every system variation, he could pull it up on a screen, what it's done from the very start, from when he researched it, when he traded it, when he stopped trading it. So initially in his early years, he was using this combination of systems, and it was doing very well. And then all of a sudden, it started just not working. It started losing money month after month. And he decided that the markets had just gotten quicker. He was trading on close after the close. He had to anticipate. And he used volume as part of it. So he had to anticipate when a market was going to meet the conditions on a close, and that ended up being a very smart thing. But I said, you have the original systems, that you dropped, and it was the most remarkable thing. He puts up this chart on the screen, and it's like a hill. It goes steadily up, and then it starts going down, and he gets out after 4 or 5 months. But that was like 10 years ago, whatever number of years, and it's never worked since. It just continually lost money. And this happened to him a number of times. So had he not adapted, had he said, this system has worked, I'm going to stick with the system, I'm not changing it, he would have been wiped out multiple times.
Well, it's interesting because it's almost the idea that, like, we'll say an animal in the wild, like, it can't sort of feed at the same place every day, or eventually the other animals know to stay away. And I think even the timing around his first change in markets, it reminded me when I first started out in kind of 2000, 2001, we had, the first DMA machines for trading into the market without a broker. And I look back at how much easier it was back then, simply because you had all the old-fashioned guys at the mutual funds who would just throw these massive trades into the market like a brick, and you would just, in trading futures, you could take the other side of either a spike or a decline right at the close and get out of it 15 minutes later when the market calmed down. And, that was something that kind of worked for about 5 years, but then there was just a point at which they weren't making that mistake anymore. They had the same machines we had, and it just couldn't work.
Yeah, so you have to adapt.
Another big theme that came up an awful lot in this, and it's almost a thing that goes back to, you'll read about this when you read, Jesse Livermore's trading system as well. The importance of not trading. There was a lot of the sugar trades is the very idea that there's sort of, and I think Monroe Trout, I believe, used to have his traders, they weren't allowed to look at prices on their screens. They had to just do analysis and then put the trades in. But this thing of if you put someone at a trading terminal with nothing much to do all day long, it's analysis or, trade the ticks in the S&Ps, they'll trade the ticks in the S&Ps, even though that's, negative NPV trading. And I noticed that some of the guys, there was one guy towards the end, one of the stock traders who had a job and traded, and then he quit his job and started trading full time. And almost this was his problem, was that now he had the free time to trade the ticks and had to stop doing it.
Yeah, so that's quite an important point. Is and I use there's a quote by Debussy that I like a lot, which is and I see you're a musician by the guitar.
A very bad one.
But it's basically music is the space between the notes, and I love that quote because it's so apropos to trading, because in a way trading is the space between the trades. Now, so I can think of one great example. There's been a number of examples, but there's one trader I interviewed in Hedge Fund Market Wizards who basically started. He called himself he calls himself a long short trader, but when I really got down to digging in, it turns out he's never had a double-digit short position. So always his shorts are like single digit, and so it's never a big part of his thing. So really, he's more like a long-only trader. Started his fund in October '99. It could have been worse timing. He could have started in January 2000, or February 2000, but it's pretty close to a horrible time to start fund. Particularly for a predominantly long-only trader. So when I had interviewed him, it was I guess he had about a dozen years past that point, and he was up cumulatively before his profit and before the fees, but just on his trading, or you can think of his own account portion, he was up like about 900% cumulatively. Wow. S&P during the same time was flat, literally flat. Either side of zero by 10%.
Yeah. So
how does a guy who's predominantly long only, accumulate 900% return, compounded, when the index is itself flat? And it was flat because his starting point was near one peak. You had the big bear market in 2000, 2002, and then you had the other big bear market again in 2000. So his track record encompassed two giant bear markets. So the answer was, of course, he was a very good stock picker. That's part of it. But a really important part of it is that he didn't feel he had to trade all the time. And so when the market was just not right, he just didn't trade much. So during 2000, 2002, he actually was up a little bit during that period. He made a few trades, but he didn't trade much. And then in 2008, he lost, I think, single digits. But yeah, that's a lot better than having a 50% drawdown. And again, because he didn't trade much. So his success really was to his ability to not trade. And talking about the screens, that reminds me of Seykota. When I interviewed Seykota, I kind of, at one point I looked around and said, "Where's your quote screen?" And he said, "Having a quote screen on your desk is like having a slot machine. You keep on feeding it quarters all day long." So he just had a system, and he put in his orders, and he didn't want the temptation of looking at the market intraday.
Yeah. Now, an interesting thing as well in this book, like there were some really massive returns that some of these guys had generated, but towards the end of the book, you pointed out, I think it was Parker was the guy with the longest track record. He had been trading, I think it was 22 years. And I think you looked at a 20-year record of his, and he had a return of about 20% a year. And I guess I wonder, because you've been following the greatest traders in the world for quite a while now. What do you think? When we look at, often people say to me, what can a great trader earn? And I say to them, well, if you look at the returns of the greatest traders who've been doing it for a long time, if you look at people like Soros or Buffett or Jim Simons or any of these people, to a reasonable extent, I would say that your long-term, 20 to 30-year return expectation is probably a little bit capped by at that level. Like, there's one of the things that's funny about running this YouTube channel is that when you put financial content up on YouTube, you get all these ads on your channel, and they're all for sort of trading coaches. And there's one in particular who tells people that they can generate a 2% daily return every day on their trading if they I can sell you that system, Jack, for $2,000. So I would advise you to sign up. But what are your thoughts on, like, what is a reasonable hugely outsized return over a long period of time?
So actually, but I should correct, Parker didn't have probably Brand has the longest record.
Sorry.
Yeah, but like 35 years or whatever. But and Grant's over that whole period compounded around 58%. But so how much? I think the classic example is somebody like Druckenmiller, who, he went on for many years after I interviewed him. He still traded for like 20 years after I interviewed. But I think his career from his original fund. His original fund until he retired, I think, was roughly about 30 years. I think he compounded close to 30% a year. I mean, that's kind of sort of like classic, phenomenal track record with size money. In this book, you do have people like Sal Ammert, who I guess about 13 years and 300%, but that's on a small amount of money. And if he had allowed his money to compound, he couldn't do that. It's just he kept pulling money out, and even now still trading a couple of million maybe. But that type of 300% compounding would have made the size way larger. So Gus knows what size he can. He trades very aggressively, and he knows at what size he can trade that at. So I think the question depends not only on length of track record, but whether you allow the account to grow, compound. If you allow it to compound, it becomes almost like somebody like Bruce Kovner. When I interviewed him, I believe he had like close to a 90% average return for 10 years, which is a long record.
Yeah.
Right. But, I'm sure, I don't know what his record was afterwards, but after he found Caxton and it was a firm managing 10, 20 billion or whatever, surely, we know, I mean, I don't have to look. It's impossible to keep those type of returns if you're managing really big size. So it's a function of how much money is under management and the length of track record. There is one trader in here, Jeff Newman, who literally started with $2,500, I believe about 15 years ago or so. And when I interviewed him, he was up to 50 million. And the kicker is I just kind of, he keeps in touch since I met him. And literally yesterday, he sent me a message saying, I just did 100 million for the year. And that's like a crazy number. And I say 100 million cumulatively, meaning he turned 50 into 100. He said, no, he's literally made another 100 million this year. So, and this is a guy that started with $2,500. And this is 15 years ago. And he is, not trading real money. I mean, an individual, right? I mean, the 50 million, it's going to 150 million in 1 year. So, there are some people who, but he's extraordinary. So I think there are, some people can push the envelope, but realistically speaking, for what's a reasonable expectation, if you could do plus 20% for 20 years plus, you're doing very well.
One of the things that I really enjoy about the book and all of the books, because by the way, I've often recommended your books to people, and they say, well, which one should I get? And I kind of say, well, you should get them all because they're all, you know what I mean? They're a series and there's not like one that'll tell you more than another. One of the things I thought was very interesting about this one is just how fresh it is. I mean, there's some of the interviews in there that are probably 2-3 months old. Is that correct?
Well, I did the interviews in 2019, and I did some. I did a couple that were in this year. So they're fairly recent for the most part.
Yeah.
There were 2 interviews that were done this year. The others were wound up by the fourth quarter. at the fourth quarter, before the fourth quarter of 2019. The two exceptions were Shapiro, because he didn't want to do an interview. He didn't want to participate. And he was coming, he is one of those traders who, my book kind of was the first book he read on trade, about trade, or the first influential book. And it sort of got him, it sort of gave him, it was an influential book, and he wanted to, for him, and he asked if he could meet me. I was in Boulder, and he had a wedding in Boulder. He asked if we could get together. I said, sure. He was telling me a bit about his history. And I said, well, that's pretty interesting. Would you want to do an interview? And he said, no, I just don't want that publicity. I don't want to do it. And he refused a number of times. So when I met him, we just talked for a couple of hours, and I didn't turn on, because I asked him again, is it okay if I turn on the recording? He said, no, I really don't want it. And it was a fascinating conversation. And sort of when I had gotten the book, I was working on the book, and the next, so 6 months, or 4 or 5 months later, I figured I'd email him. I said, look, I still think it'd be great in this book. Would you reconsider? And went back and forth, and I get an email finally saying, look, I'm really sorry. I really appreciate what you do and everything else, but I don't want to participate. And literally less than a minute later, I get a second email that says, screw it, let's do it. So I did that. I did that by video conference because I'd already spoken to him, I'd already met him. And, so it was, so we had the conversation again. So that was the first time I ever did an interview that wasn't live for any of the market, was his books. And then there was a second exception because of COVID, I was no longer traveling. And it was a trader I wanted to get to that I didn't get to. There were more than one, but there was one. And so I did that on video because that was the only practical way to do it.
Now, how do these people react when you contact them? Because just to kind of tell you a funny story, when you first called me, I think probably about 8 years ago, I don't know if you remember our phone call, but I at first I was a bit confused when I was on the phone with you, because I've been a big fan of your books for years, and I have them all around the office, and I recommend them to all sorts of people. And so, a lot of my friends would know that I'm a big fan of your writing. So then I got a phone call, and it's Jack Schwager on the end of the line. And I was pretty sure that it was one of my friends winding me up. I kind of thought it was like an Ali G type thing, and I'd be told, like, you idiot, Jack Schwager wouldn't call you up. So how do people react when you contact them? Because I got the feeling most of them kind of had read your books.
Yeah, at this point, it's big difference from the first market was book, obviously, where people didn't know. Although I knew a couple of traders personally. And now, and even the book before the hedge fund market was his book, I'd say that I don't know if all of them, know who I am or read my books, but certainly a majority of them have. And it's kind of almost amazing how many of them say it was like the influential book in there. It was the book that got them into trading and stuff. So I get that. So that's kind of, well, that's a big advantage because they already know who I am, and they benefited because the book was positively influential in their life. And so it makes a yes much easier. But, I don't know if they're surprised or whatever, or not. Usually the first contact is by email. So I don't see what their response is, other than what they answer.
Well, I guess I would wrap up just by saying that, I strongly do recommend this book to my viewers out there. And I think one of the real reasons I recommend it, because there are other books that sort of interview traders, but I think one of the reasons these books are so good is that Jack is a trader himself, and he kind of asks all the right questions. Like, as I'm reading the book, I'm going along and I'm thinking, yeah, but what about this? What about this? And sure enough, Jack will ask the very question that I would ask. And actually, back to our first conversation, my partner was sitting next to me when I was on the phone with you. And she said to me after a while, she said, after I hung up, she said, you really gave him an awful lot more information than you usually give out. And I said, well, he just asks all the right questions.
Yeah, actually, one of my pet peeves with interviewers, I'm not talking about trading, but generally interviews in general, and is, ask this, you're waiting for them to ask this question, it's like grading that. Why don't somebody says something and it's such an obvious follow-up and they don't ask it. It just irritates me. But I love interviewers who do ask somebody like Terry Gross on this podcast Fresh Air, who's been a great interviewer for a year, probably one of the best, in my mind, maybe the best ever. But she almost always will ask if there's a question I have. If it's not asked immediately, she'll come back to it. So she does this, and I really like that. So I guess I try to emulate that, or I'm at least conscious of it. I'm conscious of ask the obvious question,
Yeah. Well, thank you very much for coming on my channel. I'll put a link to Jack's book in the description below, and I strongly, strongly recommend it, and in truth, all of his other books, because they're all, huge value added. And thank you again for coming on. I really appreciate it.
Thanks, Patrick.